As you know by now, stocks could not string together another day of gains as interest rates move significantly higher. Let's welcome in Cameron Dawson, the chief market strategist of Fieldpoint. She's back with us today. It's nice to see you again. Welcome.
Thank you for having me.
You know, so just when we thought we were maybe out of the woods, rates take a big jump, stocks, certainly tech, takes a big fall. Is that a signal that it's too soon to declare the worst is over?
I think it is, because the reality is that we're now in those tech areas seeing a series of lower highs and lower lows, which means that the trend has certainly weakened significantly and we're no longer in an uptrend in those areas. And the real challenge is about interest rates, and it's real interest rates. And the liquidity environment has worsened very rapidly for these long duration growth oriented names. Just a month ago, the real interest rate on the 10-year was negative 1.1%. Today, it's just negative 0.1%. So this should put downward pressure on valuations. And so kind of regardless of what we're seeing in the good earnings side of things, we think valuation is where things continue to get challenged.
See, the flip side of that is that, you know, the more bullish folks who come on, including some that we've heard this week, like Scott Minerd suggests, look, everybody's gotten way too negative, so that makes me want to have a contrarian view in and of itself. And I think that rates are going to top out and get back into a range, you know, around 250 on the 10-year, not 280 plus where they are today. Is there something to that?
Well, I think we need to be careful when we're thinking about rates topping out, because it's why they are topping out. If the Fed is still saying that it wants to move to tighter policy, it's still raising interest rates, it's still doing QT, and yet rates start to roll over, that's a sign that the market is getting scared about growth and that it's likely pricing in rate cuts in the future. That's what happened in October of 2018. So even as the Fed was still raising rates, what we saw is long rates and short rates start to roll over. And that's what really set up for those really weak markets in December of 2018. So I'm not so sure that I would find solace in rates moving lower from here because of what it could say about growth.
So are you suggesting then, because you think valuations still have to come down and you're not so sold on the fact that rates have topped, that you don't think the lows are in?
I think that we retest the lows from earlier this year. We could move slightly lower off of those levels. The lesson that we learned from 1994, which is Bullard's favorite soft landing, is that the Fed was raising interest rates rapidly. And we actually saw 4 retests of the lows that we saw during that year. So I think that's still very much on the table. And then the question, if we move lower from there, is really on earnings, because we do see valuations moving lower, but can earnings offset that? And so we have to see what companies are saying about commentary going into this earnings season, and if they're going to start moving numbers down. We're hearing some shaky things coming out of the consumer, which could mean that some of those earnings numbers are too high. So that's the key driver if we retest the lows or move lower.
I mean, at some point, though, the market must know a lot of this, right? I mean, the economy is still very strong. Even if you're hearing some, you know, maybe tepid comments regarding the consumer. You know, the market itself has had an amazing ability to absorb bad news, which suggests to some that it's all in the market. And then really at this point, what doesn't the market know? It does know that the economy's strong, so you can absorb a bit of a slowing consumer. We're not talking about a crashing consumer.
Well, I think that the reality that we're dealing with is that even though the Fed is signaling that it wants to be tighter, it actually isn't tight at today's levels. And so that's why the market can remain so resilient and why we really haven't seen any kind of stress show up in the economy yet. We know that every time that the Fed hikes, something breaks. Sometimes it's systemic, like housing in 07 and 08 or corporate balance sheets in the early 2000s. And sometimes it's small and contained, like energy in 2014. So the question is, if the Fed really does deliver on those 8-9 rate hikes, what breaks this cycle? And we don't know the answer to that yet, but we do expect to see credit spreads moving higher, which should start to reveal the truths under the surface.